Welcome to this free educational video presented by Tax Free Life Advisors, a licensed financial services insurance agency with independent agents and advisors nationwide. In this video presentation, you will learn some basic concepts involving life insurance and annuity products and how these products can be used effectively to build and grow tax-free assets, plan many and various tax-free benefits, and how annuities are used in retirement planning. We have additional free video presentations that will focus more specifically on different products or concepts, such as Indexed Universal Life versus a Roth IRA, why and how to plan for long-term care, and many others. As we prepare to go through this free educational video, it is important that you understand our compliance and legal disclaimer. The information contained in this presentation is for education and illustration purposes only. Specific insurance company brochures and illustrations must be consulted for individual planning. No legal, tax, or investment advice is offered in this presentation. Let's begin with a conversation about why American citizens should take a serious look at life insurance products as a way to build and grow tax-free assets with various tax-free living benefits. First of all, we consider our national debt, our unfunded liabilities, and a more than 38-year track record. As you can see on the screen, our current national debt is estimated to be greater than $17.5 trillion. And our estimated total U.S. government unfunded liabilities are estimated to be greater than $129 trillion. And for 31 out of the last 38 years, the U.S. government has spent more on programs than it has collected in taxes. A second reason why American citizens should take a serious look at life insurance products as a way to build and grow tax-free assets with various tax-free living benefits is the subject of Social Security and Medicare. These are excerpts taken from the Social Security and Medicare Board of Trustees report dated November 9, 2012. On Social Security, the report states, after the year 2020, the Treasury will redeem trust fund assets in amounts that exceed interest earnings until exhaustion of trust fund reserves in 2033, 3 years earlier than projected last year. And on Medicare, the same report states the projected trust fund exhaustion date is 2024, unchanged from the previous year. And then finally, the reason why American citizens should consider life insurance as a strategy to build and grow tax-free assets is because of the historical top marginal income tax rates in our nation's history. On the screen, I have a graph depicting the top marginal personal income tax rate from 1913 to 2003. Two things that jump out from this graph to our attention are, number one, that from a historical perspective, we are currently in a rather low top marginal income tax bracket. And the second item that jumps off of the screen to us is that there have been times in our nation's history when the top marginal personal income tax rate has been as high as 94%. And so with all of the items that we've just discussed, our national debt, our unfunded liabilities, our more than 38-year track record, the state and condition of Social Security and Medicare, and our historical top marginal income tax bracket rate from 1913 to 2003, it is very reasonable to believe that taxes will most likely be increased in the future. And so if we do believe that taxes will be increased in the future, it is prudent for every American citizen to take steps to learn how to build and grow tax-free assets, or to build assets that would be sheltered from increasing income tax rates. Now, we look closely at permanent life insurance for tax-free financial planning solutions for many reasons. Here are just some of the taxation highlights. Permanent life insurance allows for unlimited contribution levels. Unlike a Roth IRA that has a $5,000 annual contribution limit, as well as income limits for a person or household in order to participate in a Roth IRA, permanent life insurance does not have these same limitations. Secondly, the IRS rule for distributions prior to age 59 and a half does not apply to permanent life insurance. If you put money into a Roth IRA or a tax-favored retirement plan, a tax-qualified retirement plan such as an IRA or 401k, there is a 10% penalty for any withdrawals made prior to age 59 and a half. I would also say that the IRS rule requiring minimum distributions starting at age 70 and a half also does not apply to permanent life insurance. And then finally, cash value growth inside of permanent life insurance will grow tax deferred and properly structured will be withdrawn tax free. In addition to the tax-free advantages that permanent life insurance provides, we also have the option of using an overfunded indexed universal life product, or for more traditional retirement planning with IRAs or 401ks, we have index crediting strategies available in fixed indexed annuity products as well. Here is a very general and broad example of how an index crediting strategy works. And in our example, we have an account balance of $100,000 inside of an insurance-based product, such as Indexed Universal Life or an indexed annuity. And the way this index crediting strategy works is that the principal is protected with a contractual guarantee to not lose money based on losses in the stock market. In addition to that, growth inside of the account or interest that is earned inside of the account is tied to the growth of an exterior stock market index, such as the S&P 500, the Dow Jones Industrial Average, or other various stock market indexes, both in the United States and around the world. In this particular example, we show an account with $100,000, and in year number 1 of our example, the stock market index had growth throughout the first year. And at the end of that first year, the growth of that stock index is then calculated and then applied by a percentage to interest earned inside of the index crediting account. In this example, we have an earnings of $13,850, or just north of 13.8%. Now, in year number 2, we have sort of a volatile year, but we still have growth at the end of the year. And again, we capture growth based on the growth of a stock index. And at the end of the second year, that growth is then calculated and then credited to the account as interest earned. Now, you'll notice at the end of each contract year, there is a feature known as or referred to as an annual lock-in, which means that at the end of each contract anniversary, when the interest is calculated and credited, it is then locked into the account and not subject to any losses into the future. So in our hypothetical example, in the third year, we have a loss in the stock market index. But because of the annual lock-in feature, our account did not suffer any losses from the declining stock market index, because we had locked in our prior gains from the first 2 years. Now, at the beginning of the fourth contract year, we again start over tracking the performance of a stock index, but using the annual reset feature, we are able to participate in growth or recovery in the stock index in the fourth year from where we had locked in our gains previously. So at the end of the fourth year, again, we lock in our annual gains, they're credited, and we begin all over again tracking the stock market index. In this example, in year 5, the market had another declining year, and so we simply locked in the gains from the previous year and did not participate in any losses. Now, where will the market go from year to year and into the future? Well, we don't know for certain. We do know that the market has growth years and it has years of losses. This is a powerful concept that will allow a client to participate in the gains of a stock index without putting their investment principal at risk of loss if the market declines or has significant losses. Now, what we want to do is begin to look at how insurance-based products such as permanent life insurance or indexed annuities can work in the real world. Now, the first concept I have to share with you is a concept where an individual male age 45 has an interest in protecting his family as well as building and growing tax-free assets and generating a future tax-free income stream during his retirement. And so we're looking at an indexed universal life product, and then we're showing a comparison with alternative products. Now, the product that we are going to illustrate is a summary overview only and does not take the place of insurance company product brochures or illustrations. And the illustration provided contains non-guaranteed projections that may be higher or lower in the future. And the Indexed Universal Life product illustration is based on an annual average return of 8.5% in the non-guaranteed crediting strategies column, and the back-tested 25-year historical yield is 10.02%. Now, the other financial product, or the comparison financial product, may be any financial product. It could be CDs, money market, fixed interest accounts, or other. The illustration shown, however, is based on the actual compounded growth rate of the S&P 500 from 1990 to 2010, less 1.5% for fees and expenses, and does not count any dividends. It is also assumed that the other financial product is funded with after-tax contributions, and any gains are tax-deferred followed by tax-free withdrawals, similar to a Roth IRA. Now, we recognize the limitations of the illustration because a Roth IRA has a maximum annual contribution limit of $5,000, whereas the product that we are presenting is much higher than that. The income projection illustrates creating a guaranteed life income personal pension plan or a single premium immediate annuity with the accumulated account value at retirement currently estimated at a 5% payout factor with no remaining balance to leave beneficiaries. This presentation does not provide any legal, tax, or investment advice. This is an insurance product recommendation summary only. Please consult the insurance company product brochures and illustrations for specific information regarding the purchase of this product. Now, let's begin. We have a 45-year-old male in our example who's going to make annual contribution payments of $20,000 per year up to his projected retirement age of 65. On the left-hand side, we have an Indexed Universal Life product, and on the right-hand side, we have an alternative financial product that he might consider placing his annual contributions. Now, when we look at the side-by-side comparison, on day number 1, there is a income tax-free death benefit on the Indexed Universal Life product of $421,628. On the alternative financial product, if he were to die day number 1, his family would simply receive his account balance as a refund. But assuming that contributions are made over a 20-year period of time to age 65, on the Indexed Universal Life product, the death benefit now, income tax-free, has grown to $1,306,950. The potential account balance on the alternative financial product at age 65 could potentially have grown to $952,162. But now we're assuming that the gentleman is going into retirement and wants to begin drawing a stream of income from his accumulated account values. On the Indexed Universal Life product, the gentleman is able to draw an income tax-free stream of income of $116,582 a year. Now, from age 65 to age 90, that would equate to $2,914,550 of income tax-free retirement income during those years. On the alternative financial product, if he were to convert his account growth balance into a personal pension income annuity with a 5% payout factor, he would be able to draw out about $47,608 a year. From age 65 to age 90, that would equate to $1,190,202. Now, when we compare what is left to his family and his loved ones, if the gentleman were to pass away at age 90, he would then be able to leave his loved ones and his family a income tax-free death benefit from the Indexed Universal Life of $975,276, nearly $1 million, whereas the personal pension income annuity would provide zero left for his family, his beneficiaries, or his heirs. Now we also look at this illustration sort of from the big picture. We call it total benefits of ownership at age 90. We have the tax-free death benefit at age 90 of $975,000, the total tax-free income that has been withdrawn from age 65 to age 90 of $2,914,000. So we have our total benefits of $3,890,000 minus the client premiums or the client contributions to the contract from age 45 to age 65 of $400,000. That leaves us with a total income tax-free benefits of ownership of $3,490,826. Total benefits of ownership at age 90. Now we further illustrate and compare the Indexed Universal Life product with an alternative financial product. The total benefits of ownership at age 90. And you'll notice as a side-by-side comparison there that the Indexed Universal Life total benefits of ownership $3,490,826 versus total benefits of ownership of the alternative financial product of $790,202. Now let us progress to a second example or a second illustration. And this is a tax-free wealth transfer plan with living benefits and long-term care for a 60-year-old male. Now, the appropriate funding for a plan of this sort would come from money that is currently not designated for income or for future income. It is money potentially used for unexpected emergencies, but not planned to be used for any major purchases. It would also come from money that is currently earning little or no interest, perhaps in CDs or money market accounts. And it could also come from money that, apart from an emergency event, will most likely pass to your spouse or loved ones in the future at your death. So this is a single premium life index life product and a tax-free wealth transfer plan. In our example, we're looking at a single one-time premium transfer of $250,000. Now, in the accumulated account value or the account balance, immediately on day number one, there is a 10% premium bonus applied to the account value. In this example of $25,000. It also will provide, over the course of the product, a maximum monthly long-term care benefit of $7,576 per month if long-term care benefits were needed at some point into the future. It also provides a minimum contractually guaranteed tax-free death benefit of $468,604 to the family, to the loved ones, or to the beneficiaries. Now, if we project into the future and illustrate into the future, at age 85, the death benefit, income tax-free, will have grown to $692,015. So again, these are monies that are currently earning little or no interest. It's money that is not designated for income or the purchase of any major financial items in the future. It is used possibly as an emergency fund reserve, and if nothing happens unexpectedly or as an emergency into the future, will most likely pass to your family, your loved ones, and your heirs at your death. Now, this product also provides a 100% return of premium guarantee, which essentially means that if at any time in the course of the future after this product has been purchased and you currently own this product, if you decide for any reason that you want to close out the product and cancel it and receive a full 100% refund of your investment premium, you're guaranteed to never receive less than your initial premium. premium payment, sort of a money back guarantee or change your mind feature. We now transition from life insurance products to consider index crediting strategies for retirement planning using fixed indexed annuity products. Now, why should you consider an indexed annuity product for retirement planning? And the question, of course, is now that you've worked your entire life to get to retirement, will your money stretch far enough? And that is the purpose of using an indexed annuity for retirement planning, is to guarantee that your money will be there for as long as you live and as long as you need it. So here are some financial planning principles or concepts. The first one we want to consider is the rule of 100. And the rule of 100 essentially says that whatever your current age, this subtracted from 100 will reveal the amount of your life savings or invested assets that should be subject to risk of loss or stock market risks. So in this example, a 70-year-old subtracted from 100 would be 30. So about 30% of his life savings or nest egg should be placed in the market and placed at risk. The 70% of the assets should be protected and guaranteed. Now, an indexed annuity is one way to provide a guaranteed principal protection that your money would not be lost in the event of a stock market crash or an economic downturn. And at the same time, give you the opportunity through index crediting strategies to earn interest that is tied to the growth of a stock market index. But what about retirement planning? In this article published in Insurance Newsnet magazine, January 2014, indexed annuities increase retirement success to 97.5%. Now, the way this is accomplished is through a new solution that has been offered in an indexed annuity contract, and it's called a guaranteed minimum income rider. Guaranteed minimum income rider, or guaranteed minimum life income rider. And the way this income rider works is it is attached as an optional benefit to the indexed annuity contract. There is generally a fee or charge for this benefit. But what it allows the contract owner to do, or the annuity owner to do, is to allow that their lump sum principal be protected against loss to the stock market, to earn interest continuously throughout their retirement based on the growth of a stock market index, and at the same time, using the income rider, generate a guaranteed income stream for as long as they live. With the benefit being this: if they go into retirement with the income rider and begin to draw income, but perhaps for some reason do not live very long in retirement and end up passing away only a few years later, the principal amount inside of the indexed annuity contract will still remain and will pass to your loved ones, to your heirs, and to your beneficiaries as a lump sum benefit. However, in the opposite case, if you live an extraordinarily long period of time in retirement and you're drawing income from your indexed annuity through the income rider, and perhaps over past age 90 or even up to 100, your account value is depleted because the withdrawals did not sustain, or the interest earned did not sustain the account balance as income has been withdrawn, then you are guaranteed, even if there is no income or no money left in the account, that the income stream will continue for as long as you live. So you're protected really on both sides. You don't lose control of your principal. Your principal still earns interest and will be passed to your loved ones at your death. But in the event that you outlive your money, your income is guaranteed through the income rider, guaranteed life income rider, to never go away. So who will get your legacy? Will it be your family, your church, or charity? Or will your life savings be eaten up through the medical profession, medical bills, or through high taxes in the federal government? Someone said, if I die, why do I need money? Of course, the answer is you don't need anything after you die, but your family, your business, or your favorite charity, they just might. So this presentation has been a basic and general overview of various life and annuity insurance products. Nothing in this presentation is intended to replace insurance company product brochures or illustrations, and individual planning must be done to make any specific recommendations. I encourage you to meet with a licensed independent agent and financial professional to discuss your questions and your specific needs and goals. You may request a free, no obligation consultation through our website, by email, or through phone. Thank you for your interest and your time.